Hey, good morning, everyone. Marty Mazzora here. It is Friday, the 15th of January, 2021. Today's the day when we score our macro index. Just got that done and decided to just do a really quick video for you. We're pretty embroiled in portfolio work, doing some rotations. I outlined those. Nothing major, but things that I'll just say at the margin we think are important, and we're incrementally expressing what we think makes sense as our thesis evolves into this crazy world we live in. So again, this will be the macro update for the week. If I have time, because I'm going to try to keep it quick, I'm going to just run through just a real quick basic technical analysis of the S&P 500 at the end. So in front of you is our own index. Created this back in July of 2017, back tested it for a couple of decades at key spots. This is what it looks like, at least for its life. We dipped into the red for the first time on a real-time basis. Of course, back testing, we got red a lot, leading into past recessions. But last year in the late summer, we came in, dipped below. A lot of other things, some technicals as well, had us hedging portfolios at that time as well. And of course, we know what happened. But this was actually all pre-COVID stuff. So we saw fragilities in the data. And then, as I've reiterated a gazillion times, there's a lot of debt issues that are historic as it relates to our economy, actually the global economy. And now we come out of it. It looks kind of like a stock chart where you come in here, you break through this support, or you test it, and then finally you break through it. Again, you come back and test it, try to test it again, you fall apart, you come back to it. Now we're testing it. If this were a stock or an index, I'd say, this if we break down here, you've got this declining trend. You could say it's called a bull flag, and we could come through that, or we may break down below. You can run a technical analysis like this on just about anything. And so we'll see, but that's not what we're doing here. We're actually scoring 49 different data points, and I'm going to run through right now the items that actually moved the needle a little bit, both good and bad. So retail sales have begun to roll over. Your Census Bureau number comes out on a monthly basis. This is the Johnson Red Book, more high frequency, and this is online sales. Even those have begun to roll over, but we're still scoring these in the green. But we bring these two together to give us our brick and mortar retail numbers, and that one lost a point here week over week. As we know, we've got more stimulus coming. We'll see what happens. Last night, the president-elect promised more to come as well. I wrote about that in the morning notes, so I won't belabor that here. Mortgage purchase applications actually had a big spike higher, so that gained a point. We had a nice rate of change, as you can see down here. We've been kind of consolidating mortgage applications. So again, there's much we can talk about on housing. I'm sure I will on the blog going forward. U.S. job openings, something you do not want to see coming out of some real recessionary conditions. I've noted on the blog that I think we would be definitely going back into those recessionary conditions were it not for all the stimulus that is forthcoming. So we'll see. I think they will probably save us from a double dip, at least until or as long as they continue borrowing and spending in the economy. I don't probably have to tell you that that's not something that should make us feel warm and fuzzy about the future, if indeed this growth and these retail sales and things, although retail sales are rolling over, but if there's just so much artificial help that's coming from the top down, long term there's ramifications that we'll talk about, and we have talked about a lot on the blog, of course. Another input that should be and is concerning, it certainly is to me, is what we're seeing right here. This is the small business survey. This is the overall optimism index, and you can see the big major plunge month over month. They're concerned about higher taxes, regulations, COVID issues, and so forth. Therefore, when we drill down to the details and we look at hiring plans, yes, when you see that kind of a dip in optimism, of course, you're going to see a corresponding dip in their plans to hire new people. And again, keep in mind, small businesses employ like 2/3 of our workforce. So this is not a good sign. It's something to pay attention to. Of course, these are uncertain times, and the fact that we've got this uncertainty in the small business space should not surprise anybody. I was actually surprised to see this much optimism in light of everything that's going on. Of course, that spoke to stimulus as well. So we'll see if we can get some big stimulus plans passed. You may see this turn around and small businesses get optimistic, but when the employers of 2/3 of Americans aren't feeling good about the next 6 months or so, doesn't speak well about the prospects for the economy either. One more in our drill down into small business sentiment, capital expenditure plans. To what extent do they expect to invest back in themselves, build on their production, facilities and so forth, essentially invest back in the businesses. Big fall off there as well, all of it consistent with the headline, lack of optimism. In terms of freight, obviously very important. We track this, the Cass Freight Index, and we break down shipments and expenditures as the index does. As you know, we follow truck tonnage, trucking, rail, and so forth. Today, though, among that group, the ones that had some changes were within the Cass data, and I think this is the first time ever where I had a negative, lost a point in terms of Cass freight shipments. Okay, so shipments rolled over, as you can see here, but actually, ironically, gained a point on our index in terms of the pricing. Now, this is consistent, and I've queued this up, but I haven't shared it yet on the blog, and I will when I think I can, and I think it fits my whatever my topic of a day may be. But what we're seeing in the data, what we're seeing across the regional manufacturing surveys, in particular, but we're seeing it to some degree in services as well, is we're actually seeing input prices rise notably, more so than output prices, right? Meaning the cost of production, the things, the inputs that go into the producing of goods, for example, are actually going up notably in price. That's something that's almost an across the board complaint. But they're not raising the final goods prices as much. So you're not seeing the ability to pass through those, or the confidence to pass through those price increases. What is that called? That's called margin compression, right? That means profit margins compress. Expenses going up, prices staying flat or going down. So, this may be just a short-term phenomenon. I am somewhat bullish on inflation going forward. A few months ago, I really pounded that narrative on the blog. Lots of very respectable economists and macro thinkers don't think that's the case. They think that the output gap, which is economic potential versus what's actually happening, is too wide to see inflation. I'm a little more sympathetic to the notion that we have a Fed who is not going to relinquish the printing presses in any way, shape, or form, regardless of what they might have to say under pressure for the foreseeable future. And they will take extreme measures if they have to keep interest rates suppressed. Add a few trillion of stimulus over the next few years, and while maybe it won't be the kind of inflation that gets reflected in the very, very questionable validity of the CPI numbers, but you guys are seeing it, of course, in the grocery stores and in other places. So I think inflation is something to pay attention to. Well, we're seeing it in the price of shipping, right? While shipments are going down. So again, that reflects what ultimately is always results in margin compression. And that's not a good thing. That's not a good outlook for profits, obviously, and for stocks going forward. So we'll keep a close eye on that. Speaking of the cost of shipping, the Baltic Dry Index measures the cost of shipping dry bulk goods across the oceans of the world. And as you can see, that spiked noticeably higher. So that went from negative or neutral to positive here in our score this week. Anytime we're talking about shipping and expenses, of course, we also have to talk about the supply of or the capacity of that shipping. So So if you have ships that are in dock, for example, or being repaired or being serviced and so forth, and then you have a push in terms of demand for shipping, of course, the price is going to go up. But typically, we look at the Baltic Dry Index as a reflection of activity globally. And one thing we do know for sure is that China is going hog wild again. We're kind of reminiscent of 2011 or so, and that would be with their own infrastructure endeavors. They are buying up industrial commodities like crazy. So this, I think, reflects not a lack of shipping capacity as much as it does, a real ramp up in global, infrastructure spending, which is something we anticipate more so across the board. But right now, big time in China. So that says good things, I guess, in terms of global activity and construction activity. Whether or not that is top-down stimulus or real economic demand, of course, is something that is in question and that I have some real skepticism about. Okay, so that rounds out the good and the bad. So we had 4 negative prints in terms of inputs, 3 positive. So our net score went down by 1 point, which brings our overall score down to minus 4.08. Still, the negatives outweigh the positives. A big move from neutral scores to both the negative and the positive this week. So yeah, we have to put it all into context like I did last week and recognize that without all the stimulus, we'd be much deeper in the red. So we have to take that into our calculus as we make decisions about portfolio allocations and hedging and so forth going forward. And I will take just a couple minutes and run through just a quick technical look. So here's the S&P 500. This chart I've been showing you for years. I already have queued up right here our own volume indicator. It's the 10-day exponential moving average of the daily volume. Notice where I've drawn the circles. There tends to be some correlation between bad things to come. This is not a sell signal. It's just something to be very concerned about or very aware of. And that is when we've got this threshold here in terms of daily volume and that yellow moving average begins to push against that. Note where I've drawn the circles here the last couple of years. You can see it, it actually breaching that level while the market was going up. So this says conviction is waning while the market's going up. And in early 2018, we have an 11% sell-off there. And you can see just these dips, just follow the circles. I lined them up perfectly. It's not anything to, lose sleep over, but just something to kind of get your radar up when you begin to see volume fall apart when the market is rising. Ultimately, we had a really low stretch here of volume right before that big decline. That was almost a bear market, 19 point something percent in the fourth quarter of 2018. Notice here, right before this correction in 2019, that was about a 7 or 8% dip. Tiny stuff here, little 6-7% dip right there. Another, again, you can see that pretty often when we start hugging that line, you can look out for something to the downside. Now we had a rectangle here of just persistent low volume while the market ran up here for like a full 3 or 4 months. And then, co-op, we had that ginormous 35% decline over a 3-week period of time. And you see volume, of course, spiked. That says there's downside conviction, and it promptly rolled over as the market began to roar back. Right here in 2020, when we had our second and third dips for the year, look at that, preceded by our indicator here hitting that threshold. Preceded, or actually happened during right here. Well, folks, here we are, and here we are. So we'll see how that plays out. In terms of the momentum indicators, looking for divergences, we've got them. We've got our negative divergences on the MACD momentum indicator, and it's beginning to roll over a little bit here. When you have a rising wedge and you have bearish divergences, not a sell signal until we really break through that if you're a trader, but definitely something that you should be paying attention to. Same thing on the RSI, Relative Strength Index. That has rolled over again. That's a clear, bearish sign, bearish divergence. Notice here the upward wedge, and you had those here before the big sell-off. Somewhat of a, it would be if it's flat, from from trough to peak, that is also a bearish divergence. But these are pretty good indicators that, not sell signals until we break down, but signs that odds begin to favor something to the downside. And I've been showing you these a lot, so that's been pretty consistently the case. Government commentary, bringing in the fear of missing out and so forth, or I should say top-down commentary about trade relationships, stimulus plans coming. They've always been effective to bring in enough dip buyers to keep something very serious from happening, save for what happened in February and March. But as you know, we've got lots to parse here. Technically, there's issues. Now, I run a technical analysis every week on every single position we hold. I do a 0 to 10 score. And, we have a lot of sixes and sevens, particularly in the areas that we like going forward. Several threes and fours, some of them in even areas we like. But the market overall is just kind of, I'm going to say technically, when I look at it sector by sector, if I had to aggregate the scores, we're probably at a 5 or a 6 on a 1 to 10. So in the near term, we could see something happen to the downside. Of course, that's always the case, but technically, maybe a little more so right now. As you know, and I've been expressing lots on the blog, I want clients to know what page we're on with this stuff. We do see opportunities in a world where the world is, spending lots of money on infrastructure as one example, and of course, spending lots of money in areas that are, we'll call them eco-friendly. And then, of course, we've got parts of the world. We don't have to just focus on the U.S. that look attractive both from a valuation standpoint as well as a dividend income standpoint that we're going to be exploiting in the months and years to come. I'll leave it there. Thanks, as always, for watching and listening. Have a wonderful weekend.